Hi everybody, welcome along to the Mint monthly update for the Trans-Tasman funds. Today it's myself, Portfolio Manager David Fife, as well as John Middleton joining us today as we walk through the month of April and how the markets performed. So just passing on through the favourite disclosure and disclaimer and on to one of the interesting charts we've seen this month. I thought this was interesting because it's quite topical. If we go further for what's been happening in markets at the moment, there's been a lot of focus on housing, but also inflation and of course immigration, especially in this country and many others within developed nations. And this is an interesting chart out of The Economist, which looks at, I guess, over the last 3 decades, if not a tad more, the amount of houses that have been built and the growth rate of them relative to the working age population growth. So effectively what it's saying is that over the last 3 decades, if you look at across Australia, Britain, Canada, and I guess US and New Zealand, we're not alone in New Zealand in terms of underbuild relative to population growth. So it's certainly going to be accentuated in both New Zealand and Australia, as we've already seen in terms of rental pressures, and obviously we're seeing that in the US in terms of the OER, or the own equivalent rent, which is also slow to come down from the inflation perspective, but we can see clearly underbuild is a key driver. And then just rolling over to the New Zealand SRI fund in terms of how the month has tracked. It was a bit of a soft month for markets and especially the domestic market. Now, I mean, as you can see in the chart on the right there was actually only one sector effectively that ended up in positive territory. And that was largely driven by Fisher & Paykel Healthcare. Now, as we know, in March, we saw a trading update that was certainly positive from their perspective, and that's continued over to this month. We did see a few earnings upgrades from a few different analysts, partly on confidence around their anaesthesia opportunity. This is an area where there's over 250 million procedures annually, so it's certainly one, if their product set can get good adoption, they continue to do well, and that's given a bit of a positive boost to analysts. Also, we did see the launch of a new OSA mask, which is a nasal cannula mask, again, hoping to gain some market share and continue to do well within their product set. Outside of that, what else did we see? We saw a capital raise from Heartland Bank. This was to fund the Challenger Bank acquisition that had been expected for some time. And they actually took the opportunity to raise a little bit extra as well to use for some of their growth strategies, both here and in Australia. And it was taken up reasonably well, certainly from a retail perspective. The adoption of the rights was quite heavy, and it's done reasonably well. So we'll certainly see how that works. And again, that funding benefit that comes from the new bank will certainly support earnings for Heartland. And other names out there, we did see the Gentailers have a reasonably okay month. Now we're sort of, one of the names we're looking closely at is Contact Energy. We've seen Tauhara, one of the geothermal assets down in Taupo, start to be tested, and hopefully we'll see some earnings and some profit generation coming out of that asset in the next month. But I guess what everyone's waiting for is a decision down at the aluminium smelter in Tiwai. We saw Meridian delay its investor day into the end of June now. The expectation, of course, is that is dependent on a Tiwai decision. So the implication, of course, is it's imminent now. I've been saying that for some time, but it certainly does feel that this, with the end of the year due on the contract, it's certainly getting very close to a decision. So fingers crossed we have something better and bigger to update on next month, but we'll see. Another one out there we were keeping an eye on has been THL. Another fund is a small holding. And unfortunately, we've just seen in the last day or two after a trading halt that the company's actually had a pretty poor update. In fact, earnings guidance has been slashed by sort of 25+%. The driver of this, we always know that tourism can be a challenging space, but it was less about people booking the RVs, the recreational vehicles for rentals. It's actually more around the business model, which includes the sale of these vehicles and the cycling of them for working capital. Now, of course, we've seen, with interest rates high, and these are not cheap vehicles, sort of 100,000 plus. Demand has been good up till recently, but in the last month, they've certainly seen the demand for these fall off a cliff, very much here and in Australia. So of their giant downgrade, about half of it comes out of Australia. So it's certainly been a challenging time. Now, I guess where the market fear is set on the share price we're seeing today has actually been largely around bank covenants. Now, they haven't given us any clear detail on it, but say they're well within, and there's no need for a capital raise. But I guess the market's a bit nervous in a few sectors at the moment, and this is one that'll be a classic case of prove it to us, and then we'll see from there. But that was New Zealand. I'll pass over to John for the Australian funds.
Thanks, Dave, and over to the Australasian fund. Sort of echoing what Dave said. I mean, a difficult month for markets, but actually quite a good month for the fund. Basically, it was a month when markets were down, and we benefited more from our underweights in certain stocks rather than our overweights. Nevertheless, we did have a couple of positive stories as well. Healthcare was a standout. I mean, Fisher and Paykel held up well in New Zealand, and Telex, which we talked about last month, also fared very well with some of those catalysts we were expecting actually arriving, which supported the share price up about 17%. And in general, healthcare was a solid performer, having been weaker in the last few months. Outside of that, again, as Dave alluded to, the gentailers were, gave us some pretty decent outperformance. Basically in our underweight in Mercury, which has been very strong in recent months, and gave that a little bit back in April. And then finally, not a huge surprise, but technology was weaker in the month of April. So our positioning in Megaport, which has been a very strong performer for us of recent months, gave a little bit back. The interesting thing there was actually they had a very good result and an upgrade to their underlying guidance, and yet the stock was still down. So we weren't particularly worried by that. We bought a bit more on weakness and continue to expect the business to continue to benefit from their own improvement in the operating business and the positive trends towards AI, etc., etc. Slide on the right is probably what I'm going to talk about. I did a number of meetings last week looking at the building industry from a lot of different angles. Spoke to Kangiora, spoke to sort of general infrastructure, and ended up popping down to Tauranga to see the new Fletcher Wallboards facility, which is 400 million of capex. The unfortunate reality is quite depressing, actually, from a macroeconomic standpoint. Generally, we knew that building consents were coming off, and the likelihood was that building of residential properties would probably follow, and there was a confirmation that is happening. The reality is that most builders are continuing to complete what they're building. But the new builds or the new starts are pretty much not happening. Why is that? Well, I think that high interest rate is starting to bite, and in particular the banks are sort of being a lot more strenuous in terms of their requirements to give you funding, i.e. there's not a lot of pre-selling allowed, and that is weighing on the start of new builds. So not great there. Added to that, social housing, which runs at about 4,000 a year. The expectation is that might even fall to about 1,000 next year, because the new national government is reevaluating, funding, etc., etc. I'm not sure it's going to be as bad as that, but certainly there is no funding in place at the moment. And I suppose that was the takeaway from my series of meetings, was that we knew the private sector was under a bit of pressure, but this change in government is, best case delaying most things, but and particularly in state housing and also infrastructure. But that's a government spend is unlikely to fill the gap in the short term. So unfortunately, it feels like a bit more pain in that area to come. Moving across to the property sector. Again, actually was a pretty difficult month for property. Why was that? Well, again, it's a sort of 10-year bonds moving around the place, and inflation prints being too high. In Aussie in particular, it was probably most keenly felt because Australia had a very strong inflation print, and then the rhetoric was actually about increasing rates once more rather than cutting, which obviously weighed on those interest sensitive stocks. In particular, Charter Hall, which is an asset manager and probably feels this sort of most keenly, was under a bit of pressure off about 13%, which weighed on the fund's performance. Notwithstanding the fact that obviously that's been driving a lot of alpha in previous months. Just to sort of hammer the point home, one of our better attributes was Goodman Property Trust, which was actually flat on the month. Everything was off, 3 to 5%. what I was really going to talk about was the chart on the right. Again, NextDC we've spoken to you about a few times, and surprise, surprise, they announced a capital raise in April to fund, basically the data centers that they've yet to build. Well, we basically expected this. They're taking advantage of the share price benefit and the tailwind because of AI, and seemed very, very sensible from management. And clearly we participated in all the funds that own NextDC. And again, what does this do? Well, essentially funds the data centers they're building over the next 3 years, which, if you can see in the chart on the right, that sort of highlights that it's further investment in Sydney, Melbourne, and a little bit of leeway for elsewhere. So, actually in the short term, this was a slight negative. We were able to sort of buy NextDC stock at a discount to the current share price, and what happened? Well, the share price came back to reflect that. Having said that, I think it does set it up very well over the medium term. And again, if you remember in the quarterly, we wrote about some of the pretty punchy comments coming out of the company about the next industrial revolution. And just to sort of to stoke that fire a bit, on the capital raise call, they talked about Australia needing to invest in modular nuclear power to enable sufficient power to fund the data centers which are going to drive the AI revolution over the medium term. So still very punchy. I think still a way to go on that front, and we're happy holders, as I do think that those NVIDIA chips will translate into robust sales for NextDC and Megaport and those other sort of companies over the medium term. Anyway, that's a wrap for April. Thank you for your attention, and as usual, we thank you for your continued support. If you do have any questions, please drop us a line to info@mintasset.co.nz or give us on the phone number. But again, that was April, and we look forward to speaking to you in a month or so. Anyway, take care.